Hello everyone, welcome back to Series 4 of the GBA Lightbulb Sessions. The Great British Entrepreneur Award, in association with BT Skills for Tomorrow, have designed a free live stream series of Lightbulb Sessions to support small businesses and entrepreneurs with insightful and advice-driven sessions, featuring some of the UK's brilliant entrepreneurial minds to illuminate your path to entrepreneurial success. You can find out more about BT Skills for Tomorrow by heading to their website at www.bt.com/skills for tomorrow, or by clicking on the link in the comment section. In today's session, Great British Entrepreneur Awards Head of Content Jonathan Davis will sit down with Guy Wilmot, partner at Russell-Cooke. At some point in the life of almost every business, investment will be needed, whether to invest in an infrastructure upgrade, launch a new product, or spread the risk, and the business that has prepared itself properly will be placed in to attract investors. Guy will discuss what investors look for beyond financials, what you should be looking for in an investor, the common mistakes in raising funds for investments, and more. There is an opportunity to ask questions during this session. If you have a question you'd like to ask, you can pop this in the Q&A function at the bottom of your screen, and we'll do our best to answer these towards the end of the session. Please note that there will be a poll at the end of the session today, and all answers will be anonymous. And with that, I'll pass over to our host today, Jonathan Davis.
Yeah, thank you, Chloe, and thank you everyone for joining us today, and particularly thank you to Guy for joining us to offer your advice and expertise in this area. I always felt it's a brilliant place to start, just to get a bit more. I know Chloe introed you very briefly there, but it's always great to get a bit more insight into who you are and what you do.
Well, yeah, thanks, Jonathan, and thanks for having me along today. Well, firstly, I should mention that I'm a lawyer, I'm afraid. I'm a partner at Russell-Cooke, sort of a law firm based in London, although we work with people all over the country, and I head up the firm's technology and growth team. That means I mainly work with startups and scale-ups in many different sectors, and my work tends to involve working with new businesses and growing businesses through their life cycle. So I've worked with businesses where they've come along with an initial idea and we've taken them through, initial seed fundraising rounds, later rounds, and then eventually to exit. So I have been able to see that kind of the full life cycle. And I also advise on sort of commercial law, commercial contracts, intellectual property, GDPR, other issues like that tend to come up a lot for startups. And it's really useful, particularly when I'm helping out with a fundraising, to have some awareness and knowledge of some of those wider legal areas as well. And another thing that I do quite a bit of is startup mentoring. So I have seen a lot of investment pitches in my sort of mentoring capacity. I've seen a lot of founders pitch their ideas to investors, and I've seen what investors say in response. So although I'm not an investor myself, and I'm very much coming at it from the legal side of things, I have seen a lot of deals go through, and I've seen even more sort of pitches and awkward discussions between founders and investors.
It sounds like plenty of experience for us to tap in today. And just before we kind of get underway, just a reminder of what Chloe said. If you do have any questions for Guy, just leave them in the Q&A function at the bottom of your screen, and we'll do our best to get to them either throughout the session, if it's obviously something related to something that Guy's mentioning, or at the end. But so let's make a start. Would it be fair to say that a lot of entrepreneurs might ask, what are the first steps in getting an investment? Would it be fair to say that it's actually identifying why you need investment would be the first one to take?
I think so, yes, and I think there's probably an even earlier question, which is whether you need investment. So I think that there's a tendency, and I think it is driven by a sort of the dominance of the tech sector, and the in particular the sort of Silicon Valley tech sector, that there's a tendency for founders to often think of fundraising as just something you do as part of running a business, or it's seen as a kind of validation of the idea or the execution, that someone believes in us enough to invest, and that that takes us along to the next step in our journey. But actually, I think you need to work out, first of all, whether you need any money. There are a lot of startups that are able to bootstrap, and just to explain that term, bootstrapping is the term for sort of, living within your means and achieving growth organically without taking on investment. And there are many businesses that are able to do that. So the first thing to do is to work out, whether you need the money. And then, yes, the next step is, if you have decided that you do need the money, the next step is to work out exactly kind of what you need it for and what you're going to spend it on. And that means deciding how much as well. And there's a risk of both of asking for too much and for asking for too little. So, as I said, I do see a lot of investment pitches. One of the most common things that I see investors say to founders is, you're not asking for enough money. You've said you want to do X, Y, and Z with this money. You don't have enough. I know, because I've invested in various other businesses, and you'll need X for marketing or whatever it happens to be. And I think what's happened there is the founder has got huge ambitions, which is obviously great, and investors want to see big ambitions, but they're just going a bit too far in terms of estimating what they can do with this round, with this set of cash. So I think it's useful to be able to show an investor that you've got these big ambitions, but you've quite carefully thought about how much this amount of money will buy you, and where you can get to with that investment. So you do need to be careful about not asking for enough. The other thing is also raising too much. I mean, the other thing that we see is, people get big offers, and they think, well, the money's there, we should take it. But of course, the way valuations work is they tend to increase as the life cycle goes on. If you take more money than you need early on, that means more dilution. And you never know, you may be turning a healthy profit within a few months and don't actually need all that money you took. So it's just really about thinking very carefully about how much you need and whether you need investment. And also, when it comes to the plan for what you're going to do with that money, have a clear plan. That doesn't mean you need to, identify for every penny exactly what you're going to spend it on, but you need to have a general plan of what you're going to do with the money. Investors don't like it if you just say, oh, it's for working capital or it's for expansion, without any sort of further discussion of exactly how it's going to be spent. But at the same time, you can't be too rigid, because another thing that often happens is investors will say, well, what are you going to do if this doesn't work? Or that doesn't work. So you need to be able to say, well, if that doesn't work, we would stop spending the money on that, and we would spend it on this other thing, which we think is a viable backup plan.
Yeah, excellent. And I probably a few questions have just come out of that answer. So would you say that getting the figure wrong, whether it's too high or too low, is in your experience, is it a deal breaker? Or is it something that investors look at and say, look, you're totally wrong with how much you're asking for? It's
not. Yeah, it can be a significant issue in the earlier case I mentioned, where the ambitions are just totally out of scale with the amount being asked for. So that can be a really significant issue. If you say, look, we're raising 500,000, and an investor turns around and says, you're going to need 5 million for what you're planning to do, that can sour the relationship pretty quickly, because the investor just thinks, well, they haven't thought through what this business requires.
Yeah, and if there's I mean, you mentioned kind of 500,000 and 5 million, obviously quite a substantial gap. If the gap is smaller, in your experience, do you find that investors kind of go, okay, everything's great, you're great as an entrepreneur, the business plan is great, everything, okay, that's not brilliant, but let's just...
Yeah, no, I think that's fair. And I think they might say in that situation, let's just tone down our ambitions for what we're going to do at this stage. And obviously, an experienced investor would be able to offer that kind of input, and say, look, I think the idea is great. fantastic that you have these ambitions, but let's just scale back what we're going to do with this round.
Yeah, and you mentioned earlier in your answer about that it's almost becoming seen as something that you have to do. What would you say is kind of like a risk reward warning for entrepreneurs who are kind of at that stage deciding whether or not they need to? Like you said, it's almost become a bit of a PR exercise, isn't it? That you can put something out saying we've raised this much from this person, this person, this person. So what would you kind of say to the ones that perhaps maybe shouldn't be looking at investment?
Well, I think the question is, the question to ask is this process, is this fundraising process, the treadmill is often called, is it adding to the business or damaging the business? That's the first question. And then the next question is, assuming that the process itself isn't actually damaging the business, the next question is, is this amount of money, because there's an amount of money on the table and a set amount of dilution, you can formulate the question quite easily: is this amount of money worth it if we don't really need it? And it's almost just a case of stepping back and thinking about it. That's the main thing, rather than just sort of letting the process take on a life of itself, and just kind of flowing through, just actually taking a step back and thinking, hold on a second, do we need this? Do we need this much? Should we hold back for a few months?
Yeah, excellent. And sort of looking at the area a bit more broadly, I think it's probably fair to say that there's a pretty well-established stereotype that investors are only interested in finances, they're only interested in the returns that they're going to get. But it's probably, again, fair to say that that's changed in recent years. Beyond the finances, what are investors looking for?
Okay, so this is obviously quite a big question, and also, of course, it depends on which investors you're talking to. But I think there are some sort of broader themes that have come through. So I think the first thing is that financial returns are clearly still probably the main driver for most investors. But you've got to think about time horizons, and also you've got to think about upside and downside. So what I mean by that is that the classic VC model, if you like, the classic tech VC model, venture capital model, is you invest in businesses, you hope some of them give you a return of 10 times, 10x, and you expect the others to fail. And so what you're looking for almost exclusively is, businesses with the potential to generate a return of 10 times. But that doesn't really describe probably most investors. Most investors would probably prefer a more reliable business with more solid growth, where they're less likely to lose their money, particularly angel investors who don't have who don't have such a broad spread of investments in their portfolio usually. An angel investor would usually prefer a more solid, reliable investment over a longer time horizon. So that's still about financial return, but it's just a different type of financial return. And also, avoiding the downside as much as, trying to grab that massive, hyper growth upside. But apart from that, there are obviously various other things that investors are looking for. Social impact has become a lot more important. And at one end, that is social impact investors who will only invest in businesses where they can see a social impact, and that may be specialized. Some investors may be looking for environmental impact. But even if it's not an impact investing fund, even angel investors, want to feel like their investments are doing good as well as earning a return. So if there is some kind of social impact that can be identified, then I think that's very helpful. Even if there isn't a sort of specific social impact, I think investors are looking for some kind of mission. i.e. some kind of overarching goal that a business is looking to achieve. And the reason why it's not an end in itself, I don't think. I think the reason why mission is seen as important is it helps a business deal with unexpected challenges, because when challenges come along, everyone's aware of what the overarching mission is. So I think founders should be ready. It could be a little bit cheesy, a little bit embarrassing for some founders, but I think they should be ready to explain to investors what their mission is. And then the other thing is just a solid, well-run business where management looks like it's on top of things. T's are crossed and I's are dotted, because again, while a visionary genius might potentially make an absolutely enormous return, if the business falls apart before they get there, then that doesn't help an investor.
Yeah, absolutely. And you mentioned there about how the business is run. If investors are looking for well-run businesses, what are some of the key indicators? I know you mentioned management there, but what are some of the key indicators of a well-run business, and how do you convey that in the process?
Well, I think the main one is finances and accounts, and it's really surprising. Perhaps not surprising, because startups often don't have finance directors and things like that. But it's often surprising how that a lot of startups struggle to produce decent monthly management accounts. And I think for an investor, that is seen as absolutely fundamental, that there has to be visibility financially on what's happening on a sort of monthly or even daily basis. So while founders can't really be expected to be experts in every area of a business, I mean, to an extent they have to try, because often there aren't many staff around. I think spending some time to get to grips with accounting and finance is really important, because that demonstrates, perhaps more than anything else, in a single metric, that a business is well run, is having all of that information at the fingertips. Other things are, as a lawyer, I'm a bit biased on this, but I think getting your documents in order, making sure you've got your employment contracts and your customer contracts and your GDPR policies and all the rest of it in order, saved somewhere where they can be accessed, signed copies preferably, just that basic stuff. Intellectual property, I think, is something that investors are slightly obsessed with, in my opinion, a bit too much. But investors are really, really focused on intellectual property. Has the business done all it can to protect its intellectual property? And that doesn't mean going off and applying for expensive patents, which take 5 years to come through. It may be for some businesses, but perhaps not for most businesses. It could just be simple things like making sure that self-employed contractors have signed an agreement transferring their intellectual property to the company. But as I said, it is something that investors tend to focus on quite a lot. The other thing that we see a lot is founders getting a bit confused about what the intellectual property in their business is. So the intellectual property, when I say intellectual property as a lawyer, I don't mean the idea. The idea, assuming it can be described in a few sentences, probably isn't protectable as intellectual property. That's what a lot of founders often think of as their IP, but actually the IP arises on execution. It's the brand, it's the copyright in the software code and the website. And if you've got physical products, your design rights, and potentially your patents. But yeah, so I think those are all sort of indications that can show an investor that that a business is well run. I mean, other very sort of slightly superficial things are a well presented investment deck that just shows a sort of basic attention to detail. Feedback from staff and customers, if that's available, that could be helpful too. And also, a well-run business should have an awareness of what's happening in the market and with competitors. I have seen some pitches where an investor has asked about a competitor, and a founder has sort of replied along the lines of, "Well, we're kind of doing our own thing," and that isn't a good answer.
No, I can imagine not. And that's a really brilliant an in-depth answer there. So plenty of insight and advice there. So thank you for that. It's probably a case that particularly in the tech space, that founders are kind of becoming more or as synonymous as their business. You mentioned Tesla. You immediately think Elon Musk. That kind of idea, particularly in the tech space, as I said. So how important is it to not undersell yourself as an entrepreneur in the process, or how much do you need to put yourself forward as a person?
Well, I think you absolutely do. I mean, there is a slight tension here, because, as I said, I work with businesses throughout their life cycle, and often when a business is getting towards exit, they want to take the entirely opposite view, that actually this business can survive perfectly well without me. It doesn't need me. It now runs itself completely, and so you don't need to worry about me heading off to do other things. But I think it is different at early stages. At early stages, an investor is really investing in the founder, and you do need to be aware of that, and to sell yourself. And I mentioned earlier that it's not really about being a visionary genius. That that might be helpful, but what investors are looking for is ability to deliver. I mean, it's a cliche that ideas are cheap and execution is everything, I think is the phrase. It is true. It's definitely how investors think. So when I say it's very important to sell yourself, it's not just selling your vision. It's selling your ability to get there, and your ability to deliver the nuts and bolts of a business, to actually allow that vision to be fulfilled. But absolutely, the founder is pretty crucial at an earlier stage. I think one thing to perhaps address is sole entrepreneurs, founders, co-founders, because I think it's a bit of a myth that investors don't like sole entrepreneurs. They don't like individuals who are on their own. I think that is true of some investors, frankly. There are some investors who feel like it puts too much risk on the business to have one individual entirely responsible for delivering it. But at the same time, I don't think that describes most investors. And one of the most damaging things that we see as lawyers are disputes between co-founders. So you could just as easily make an argument that having a sole founder is safer. So I think the answer is, if you would be more comfortable having another founder on board to bounce ideas off, to act as a sort of bit of a check, then go ahead and find another co-founder. I don't think it's necessarily something you have to do to get investment. I mean, we've seen so many examples of individual founders and entrepreneurs getting investment that it's not something I would be overly concerned about.
Yeah, fantastic. And just finally, before we move on slightly, I'm imagining that this is probably a question that's on a lot of entrepreneurs, particularly in the startup phase. How do you make that first kind of foot in the door? Because these investors are going to be getting pitches and emails so often, just absolutely reams of them through their inbox. What do you think they need to do to stand out at that initial point of contact?
Yeah, I mean, this is something that I'm definitely not an expert in this, and this isn't really my focus. But I think that there are a lot of resources out there about sort of how to find investors. I think the starting point should always be your own network, if you have one, and if you're lucky enough to have a network of people who might potentially invest, that's always the best starting point, because you already know those people. If you don't, there are obviously a lot of angel networks, and even VCs will often accept some pitches by email. They may not respond to many, but they will accept them. It can be difficult. It can be difficult to find investors, but LinkedIn can be very useful for that. LinkedIn has been an absolute boon for this kind of thing. And in terms of standing out, I think the advice that you see time and time again, and I think it's right, is always send a deck. Don't try and tease it. Don't be one of the things we see is people getting obsessed with non-disclosure agreements. I said earlier that ideas are cheap, and investors get quite irritated often with founders who are sort of very reluctant to share even basic information without getting a non-disclosure agreement signed. And often when we're approached as lawyers and asked about it, often we say, well, there isn't really anything particularly confidential here anyway. That's just an idea. That isn't confidential information. Someone could copy that, and there's nothing you could do, even if you had an NDA in place. So don't do that. Do send a pitch, and keep the other information you send pretty limited. Send a pitch. Send something attention grabbing in the email. And best of luck. But it's not something I know that much about, to be honest.
Yeah, no problem at all. I think it's certainly well answered, for considering you mentioned that it's not your area of expertise. So we've talked about what the investors are looking for. So let's flip it. What should an entrepreneur be looking for from an investor? Is it a case that deep pockets is paramount, or is sort of accessibility, experience in the industry kind of more becoming?
Yeah, well, I think there's it depends what you're looking for, of course, and experience is a bit of a double-edged sword, because experience can mean you get useful advice, but it can also mean sometimes the investor is pushing you to do something that another one of their invested businesses did, and you may not actually think that's the right thing to do. But experience is clearly useful. I think the issue we see, the two issues we see, and they're at two ends of the scale in terms of problems with investors, are the micromanaging investor who wants to be involved in every aspect of the business and kind of basically slows things down. And then the completely absent investor who can't be contacted even when they are needed for something, because usually with an investment, you will need the investor's consent for certain things. And if you've got an absent investor that can't be contacted, that can make things very difficult. The other thing we see, which can be a bit of an issue, is the angel investor who really wants a job or a role. That is someone who they want to invest in the business, but that's not really their motivation. They want to have the board seat and they want to be involved in the business, which is absolutely fine if they've got something to offer and they've got skills that can be used. But often that can be quite difficult if after a few months it isn't working out. So do be wary of that. But I think absolutely the main thing to look for in an investor is trust, i.e. trust from the investor in the business to get on and deliver. And it's difficult to identify that, but you really have to try, because all investors will say that they do that, but you have to look for clues that they actually will do that.
Yeah, and in situations like that where you said, if for instance an angel investor wants a job and it doesn't quite work out, obviously that's a very, very awkward situation that you don't want to be in. How difficult is it to walk away in the situation that, let's say, that person who is an angel investor wants a job, you're not feeling too confident about that, you're a bit anxious about it, but it's the only offer on the table. How important is it to walk away, or how difficult is it to say no to that?
It is very difficult. I think it probably comes back to the earlier part of our conversation about, well, it's how do you need the money? Because if it's a question of survival, then you live to fight another day, and you would say, we're just going to have to take the money, and we'll deal with this problem later. But really do think in that situation whether you do need the money. Can you bootstrap? Can you survive for long enough to find some other investment? It's definitely something that you really want to be thinking very, very carefully about. But I think if it is a question of survival, you may realistically, a business may feel it doesn't have any other option.
Yeah, absolutely. Yes, totally understandable. So a couple more from me before we go on to the audience questions. I've seen quite a few come in. So I know you mentioned a couple kind of dotted throughout, but what would you say are, let's say, three of the biggest mistakes that you see entrepreneurs make when they're looking for investment?
Yeah, yes, three. Let me think. Well, I think they're probably all things that I've mentioned already. But I think first one is taking money when it isn't needed, and treating it as a process, as an end in itself rather than a means to an end. The next one is overvaluing the idea and undervaluing execution. And I gave the example of kind of non-disclosure agreements is where we see that come up most often. I think the third one is quite a basic one, which is underestimating the time that it takes, because everyone, literally everyone, underestimates the time it takes to close an investment. And that goes for companies, experienced VCs, angel investors, everyone. so be aware of that, and basically, however long you think it's going to take, double it to be safe.
That was going to be my next question, actually. Is there kind of a rough average, a kind of ballpark figure that you can give?
Well, I suppose there's two stages to an investment. So the first one is securing commitments or offers. So it's probably worth talking a bit about how angel investments and sort of venture capital or institutional investments differ. So with angel investments, it's usually the company that makes the running. The company prepares the heads of terms or the term sheet and sends out to the angels, and then gets some kind of commitments from the angels. And then once it's reached its figure in terms of those commitments, then it usually asks its lawyers to go ahead and start that process. With VC investments, venture capital investments, it tends to be the other way around. The venture capital firm will supply a term sheet, which may be subject to some negotiation, although perhaps not a huge amount. And if a company has got more than one, it may just be a case of selecting between them. But often venture capital funds will go in together, so there'll be a lead investor and others. So I guess the two stages are getting up to the point where you have the commitments from the angels or the term sheets from the VCs, and then the next stage is actually closing the deal. So the point from getting the commitments to closing the deal is a lot easier. That's usually kind of 6 to 12 weeks, I would say, is the rough time period. However, the time period to get to that point varies hugely, and that can be, and usually is, a matter of months rather than weeks.
Yeah.
So it often takes a few months to get everyone lined up, and then it turns from months into weeks, and it's often just a few weeks to close the deal.
Yeah, excellent. And then one final one from me before we go to the audience questions. It seems like we can't go a round table or a Zoom meeting or a round table or anything like this without mentioning the past 18 months in the pandemic. What impact has it had on the investment space, and how do you feel about it in kind of the short and medium term future?
I don't think it has had that much impact. So I think it did at the beginning. Certainly the angel investors were understandably quite cautious at the beginning of the pandemic, which also coincided with the end of the Brexit transition, of course. People were very nervous at that point, but it certainly seemed to me that it very quickly essentially returned to normal. And so I think at the moment we're in terms of investment, we're largely in a sort of pre-pandemic status quo. What that means is, I think that I can't foresee a huge crash coming, although no one can ever see them in advance. But I don't see a huge crash coming, but I don't really see a massive boom either in investment either. So I think it's kind of fairly steady at the moment, and hopefully it will remain steady for a while. I mean, there are some policy things which may have an impact. So how restrictive or not, the UK government's immigration policy is going to be may have a bit of an impact. Some other things around GDPR, but I think largely the investment activity is likely to closely track sort of overall sort of health of the economy, really.
Excellent. I'm sure that'll be quite reassuring to a lot of our attendees. So as I mentioned, we've had quite a few questions come through the chat function. So I'll whiz through those because there's quite a few to get through. So the first one comes from an anonymous attendee who says, "Does being awarded an Innovate grant via the competitive process make businesses more attractive to investors?"
I think so, yes. I think that's a quick answer. I think absolutely it does, yes. I think we've had a number of clients win those grants, and very soon afterwards managed to raise finance. So I do think that does absolutely an advantage.
Excellent. And next one comes from Talita, who asks, how do you make a reasonable estimate of how much money you need? Is it something you should discuss with a financial advisor? I don't think a financial advisor is likely to be able to offer much guidance on this. I mean, if you mean financial advisor more broadly, as in a sort of a business accountant, they will definitely be able to give you some useful pointers. I think in a way, if you can speak to other founders and other startups, that might be a better way of doing it, because it's things like estimating, how much you need for a solid Google AdWords campaign or something to get traction in this market. It's not something that any kind of financial advisor is likely to be able to give you a solid steer on, but other founders with similar businesses or people just with experience of those businesses may be able to offer you much more useful sort of guidance. Or how much do we need to pay this kind of person? It's those kind of questions, really. Yeah, brilliant. This one comes from Dina, who's watching on the LinkedIn live stream, who says, when you're talking about intellectual property, can trademarks be considered as IP or patent only?
No, trademarks absolutely are IP. I mean, in terms of what lawyers mean by intellectual property, that it's copyright, which includes software code, as well as the look and feel of things. It's trademarks and brands. It's patents. It's design rights. And those are the main intellectual property rights. There are also what we call sort of quasi intellectual property rights. That is confidential know-how, or trade secrets as well. So I think all of those are sort of legitimate intellectual property.
Okay, great. Next one comes from Alison, who says, do investors prefer to see a proactive board of non-executive directors involved in business?
Yeah, this is I think an area of tension as a business goes through its funding journey. So often there's an angel round, and a couple of angels are taken onto the board at that point. If the business then goes on to do an institutional round with a venture capital fund, there's often a slightly awkward moment where the venture capital fund says, thanks for your help getting the business to this point, but we don't, we don't think the services of your current non-executives are needed. So I think an investor at later stages has no issue and is perfectly happy to see non-executives on the board. But I think it's just a case of managing the expectations of those non-executives, that it may not be, a job for life. It's a year or two, and then obviously, when we move into the next stage of funding, then the investors at that point will have their own views on what the board looks like, and will want to move on as well. So, but there's definitely nothing wrong with having non-executives, and they often bring a huge amount of value in the early stages. But at some point, they may have to step aside.
Excellent. I think that's a really useful answer there. Next question comes from Verity, who says, "How do you value your business at seed stage?"
Yeah, this is one I definitely can't answer. I'm not qualified to answer it. I think all I will say on that is, it's my view is that it's more art than science, and it's that most founders will have some way of justifying their valuation, but it will nearly always be based on future projections that haven't happened yet. Because by definition, an early stage startup doesn't have revenue or profit, and it can't simply take a multiple of revenue or profit. So it has to project it forward and then take a multiple on that basis. So it's, as I said, it's a bit of art, it's a bit of science. There are specialists who can help with that, but a lot of businesses do seem to just do it themselves, frankly, and test the water with a couple of investors first about whether or not they've pushed it a bit far. But as I said, it's not something I'm qualified to do, so I can't advise directly.
No, that's fine. I think it was answered certainly well enough, considering. So this next one comes from Eleanor, who says, investing in creative business is more risky than a tech business because projections and forecasts are harder to estimate. Are there any tips or focus points a creative business should concentrate on for investment?
I think that's probably true, and also a creative business is, by definition, usually less scalable. I do often feel that creative businesses sometimes do have an advantage, depending on what they are. I mean, I have no idea what this business is, but they sometimes have an advantage in the investment and pitching process, in that they can use the creative content as part of their pitch. So in other words, if you're a creative business, get creative in terms of how you're pitching, because if you can sell an investor on your creative vision, then, just as I said earlier, investors looking for social impact and mission and all of those things. But if you've got a creative vision and you can incorporate it into your pitch, then that could help to sell yourself. Showing by doing, if you see what I mean.
Yeah, absolutely. I think we've probably got time for one final question from the audience. So Julie, who asks, are franchise businesses attractive for investors? I'm a franchisor with 20 branches and currently considering investment to help expansion.
Well, I think, yeah, for some investors, yes. For an investor looking for very solid returns, then that may be an attractive proposition. Depending on the business as well, it may also be something where debt funding becomes an option. So something of that size, you might be able to find some funding from banks even. So that's worthwhile considering, and then you don't have to dilute your equity.
Okay, excellent. I think that, like I said, that's all we've got time for from the audience questions. Just one final one from me before I hand everyone back to Chloe. So if you wanted today's audience to come away with three key takeaways, three key pieces of advice, what would they be?
Okay, so I think the first one, and I'll just try and summarize a couple of the things in one point, a couple of things we've discussed in one point, is firstly, don't raise more than you need. Don't raise money if you don't need to. And the third part of this is just as important. Don't be devastated if you don't actually succeed in finding an investor or investment, because I've seen lots of examples of businesses that weren't able to find investment and went on to be very successful through bootstrapping and self-funding, and scrapping some grant funds and things like that. So, don't put all your eggs into the investment basket. Secondly, do the straightforward things well. Management accounts, getting your contracts in place, doing the boring stuff, doing the boring management stuff and doing it well, as that plays very well with investors. And finally, I just have to say again, don't underestimate how long the investment process takes.
Excellent, thank you. Well, Guy, thank you so much for sharing your knowledge, your advice, your insight, and your expertise over the past 45 minutes. I think it's been a really, really fantastic session, and yeah, plenty to take away from this one. So thank you so much for your time. And with that, I will pass you back to Chloe.
Thank you.
Thank you so much, Guy, for sharing your expertise and knowledge with us today. It's been great to have you with us. We'll be back next week at the same time with Sam Jones, founder of Generate, and his talk is Dragon's Den Best Ever Pitch, How to Perfect Your Pitch. If there is anything you'd like to catch up on from today's session, we'll be sending out a replay of the recording later on today. You can find the replay and future sessions at www.lightbulb-sessions.haysummit.com. Thank you very much for joining us today, and thank you again, Guy.